Any questions? Thank you.
All right. Thank you so much, Les. It's great to be back in Las Vegas. I came to you from the North Pole, a.k.a. Dallas. I was in that ice storm. I sat at DFW last week, and from 6 in the morning until 6 at night trying to get on an airplane. I was rebooked 5 times. The first routing was through St. Louis. A few hours later, they routed me to Minneapolis. Then they decided that Minneapolis wasn't going to work, so they routed me to Washington Reagan. My destination's Chicago, folks, okay? No? So like I say, I've now been routed to St. Louis, to Minneapolis, to Washington Reagan, finally to Milwaukee. And I actually was standing at the gate with the ticket agent ready to scan my boarding pass, and they canceled the flight without telling the ticket agent. 8 minutes to go, I would have been out of there. 5 hours later, finally I got a direct plane to Chicago. I was supposed to leave Friday afternoon at 4. I got home Saturday at 6:30 p.m. So it was a lot of fun, But anyway, glad to be able to be back here in Las Vegas. What we need to do is kind of take a survey real quick. What I want to know is, which is more hazardous to your health, FASBs or HUD regulations? And I have to thank Les for at least putting me before lunch. I really don't know what I would have done after lunch with the concept of FASBs here. And at the outset, I can deal with the auditing update very quickly. There is none. The Auditing Standards Board has done nada in a year, and they are not going to do anything for quite some time. Okay? So as far as auditing, just put yourselves, in the mode that these clarity standards are there. They're going to be there for the long run. There's not going to be much change to them. The only one that's giving them any trouble, as Bob alluded to a few minutes ago, is the group audit requirement, and they are continuing to fine-tune that, and they've issued 2 documents of Q&As. And for those of you who face group audit situations, get your hands on the Q&As. If you weren't aware that there are 2 sets of Q&As about group audits, then get out there and get on your Google and Google that up and get your copy of the 2 Q&As on group audits. But other than that, there's nothing on auditing going on. So you've just now had your auditing update painlessly today, I guess we can put it. So that now leads us to what's going on in the accounting, the debit credit side of the world. You had a very good recap here of the debit credit world as far as nonprofit organizations are concerned, and I will reiterate and reinforce Bob's comments that you are in dangerous waters doing nonprofit auditing and accounting if you don't have the new audit guide, because they have redone everything. And there's a whole bunch of stuff in there that didn't used to be GAAP that's now GAAP. I mean, he just gave you a very big, broad 40,000, let's look at it from 40,000 feet. But the devil is in the details. So get your hands on the new guide, throw the other ones away, they're not any good anymore, and get into the new ones. Don't think that what's in the new guide is the same old story. It isn't. Okay? So enough said, but it's out there. Now, one of the big things that's going on for the last year and a half is the fact that the FASB has created another entity. Bob talked about the NAC, the entity that's going to deal with non-for-profit accounting. Private companies, private company financial reporting. As for long as I've been in the profession, there's been discussion, sometimes lots of it, sometimes it seems to die away. but it never goes away, and that is the question of big gap versus little gap. That's the big gap is the elephant in the room, the little gap is the mouse in the room. That debate took on a new meaning last year with the FASB forming something called the Private Company Council, which is tasked with the inauspicious responsibility of determining whether or not gap standards that the FASB promulgates should be amended, deleted, whatever, modified for the purposes of small private company financial reporting. So we're going to talk about that a little bit because that's sort of in the news, as it were, with what's been going on. Officially, it was established back in May of 2012. The mission is to address how U.S. accounting standards can best meet the users of private company financial statements. Essentially what happened for all of 2012 was finding people to serve on this council, and once they got themselves appointed, then they sat down and figured out how are we going to run our ball game? What are the rules and processes we're going to use to provide input to the FASB as to how GAAP should be modified for private company reporting. And so that's essentially all that happened in 2012, was getting it formed, getting a rule book to follow, establishing a due process system. There's a lot of people very encouraged by this, especially because of the fact that of the due process that's involved. They go through essentially the same kind of system that the FASB does. They review a new FASB pronouncement that the FASB has decided that can be an accounting principle or a reporting matter that needs consideration from the private company viewpoint. FASB decides that that's a topic that needs to be addressed. They kick it downstairs to these guys, and they issue an exposure draft. They then redeliberate it. They put together what they think is their final recommendation. They send it back to the FASB, and the FASB has 60 days after that completion of all that work to decide yea or nay to make that modification to GAAP. So they have a very structured process. I don't think it's overly elaborate. I don't think it's bureaucratic to the point where the wheels of justice would move slowly. I think they've been fairly expeditious about it. So they have a due process. Now at this point, I think it's helpful, and I didn't put a slide in about it, but I think many of you have been inundated to the extent you wanted to be by the noise coming out of the AICPA about this new accounting method called small and medium-sized enterprises, SMEs, that they've developed a structure of accounting or an accounting hierarchy for small business and medium-sized business entities. They've published it in a booklet. It's 175 pages long. You can download it from the net if you want. And it seems like a day doesn't go by that I don't see or get some kind of a communication touting the merits of this new accounting theory. Let me kill that right now for you, okay? The state boards hate it, and as long as the people who hand out my license are the folks that say, don't use it, I'm not using it, okay? I don't care who says use it. If the people who are handing out licenses say, we hate it, we don't like it, okay? Another thing that's to consider is that this new small accounting system that was developed was written by one person, not a committee. No committee ever looked at it. One person wrote it. Okay? It's one man's idea. Okay? It was not a group effort of accountants from across the nation. It was one man. Okay? So it's very myopic. It's his view of the world. And being from a small town in the South somewhere, you know, I'm afraid that may not be the best viewpoint of the world. Third, I don't know how it's going to be peer-reviewed, because how do you measure it against anything that's out there? If any of you have taken a minute to look, any time to look at it at all, you're going to realize that what happened is the author said, well, I like that FASB pronouncement, I like that text section of the tax code, I like this out of that, and he put it, and he stapled it together. He cut, pasted, and stapled it together. You know? There's no hierarchy. Okay? There's no reference book to hang your hat on. So how's a peer reviewer going to tell if you followed that accounting method? You can't. So I wouldn't even bother with it. In fact, take the time to write the AICPA and tell them to throw it out. You're not interested in it. You're not going to use it. It's meaningless. And, no, it's a piece of trash. Okay? So just, you know, move on with it. Yeah, how do I really feel? Yeah. Mm-hmm. Yeah. So, and the biggest problem is that there's no due process been done at all on it, okay? No due process. No one has looked at this. As a committee, no committee on the AICPA was formed to evaluate it or assess it. We had no option, you know, to vote on it. They just put it out there and they've started marketing it. I mean, it's ridiculous to think that, okay? All right, enough of that. What does the private company council look at? They say there are reasons that we need to consider big gap versus little gap because there's differences between big companies and little companies, between publicly owned entities and privately owned entities. And some of those differences are the types and number of users of the financial reports. I mean, when you're dealing with public companies, yeah, you could have hundreds of thousands of shareholders. You're dealing with the financial statements of a benefit plan. You've got thousands of people who belong to the plan, okay? You got a private company. Maybe the only people who care are the owners, okay? They may not even have a banker because they've got enough wealth personally to finance anything that the company needs, you know? So they don't even have a lender situation. So you got an owner. You know, you may have one user as opposed to thousands. Access to management. Management has access to the information. Okay? A shareholder somewhere in Dubuque, Iowa can't go and look up the books of General Motors, you know? But the owner of the company can go look in the books if they want. They can drill down to the detail. So they have access to information. Unlike many users of public company information, you can't go get the detail. They have different investment strategies, and obviously the ownership and the capital structure in many of these non-public or private companies is very different. You know, we run into a lot more LLPs, a lot more LLCs, things like that. Very different structures. Limited accounting resources. They don't have, you know, huge accounting departments with controllers and assistant controllers and tons of CPAs on staff, you know. They're lucky to maybe have a bookkeeper. And do they have access to financial reporting guidance? Unless they're willing to go out on the net and surf through FASB and read the FASBs on the net or something, they probably don't have much access or interest in going to the financial reporting guidance. The criteria they think about for simplifying GAAP is the relevance to the users and the cost and complexity, the cost-benefit kind of theory. Mentioned some of the implications of the differences. We have these, you know, users are primarily to satisfy credit requirements. You know, many private companies, that's the only reason they even get financial statements is because their lender wants them. Or maybe, in the case of many of you here, you know, your nonprofit organizations that are involved with multifamily housing projects, et cetera, you know, your board wants it, of course, but the regulators want it. So, you know, between the regulators and the lenders, that's about the only reason they get an audit. Management has access to the information. I've mentioned that. Strategies are different. Now, of course, one of the things they have to consider, the fact is that, you know, some of the entities in these private company circle, we're now coming to the point in the life of the entity that they're looking for exit strategies. You know, how do we get out? How do we get our money out? And so you're seeing a lot of situations where companies are trying to sell themselves. You know, the owners want to have someone take over the company. So now that viewpoint is a little different than when you talk about a public company who is under the theory or presumption that they're going to continue on and on and on even after this generation of management, this generation of the board of directors. You know, there's just to be another wave of people to replace all that. Well, you don't have that in a private entity necessarily. You know, who's going to drive the boat after the owner leaves? You know, I've done this for so many years now. I've been through a lot of situations I've seen where when the owner leaves, the company dies. I mean, there's no one else there. The kids don't want it, you know. And even if they wanted it, they're not smart enough to run it, you know. So I mean, it's a whole different viewpoint of strategy. A lot of pass-through entities in terms of structure, we've mentioned that. And so I'm not going to mention the resources and the guidance. We've talked briefly about that. Now, one of the things that became clear very early is that the FASB said there are some topics where there isn't ever going to be a difference between big gap and little gap. So just get over it, okay? Stop worrying about it. We're never going to send downstairs for the private company counsel to consider making a difference in accounting in a current FASB or some FASB standard somewhere on these topics. Forget it. We're not going to do it. Big gap is going to be little gap for these topics. What? Cash, cash flows, adjusted EBITDA, borrowings and credit obligations, liquidity. Is that, you know, I hate to use that same word again, and you probably got tired of Bob saying about liquidity this morning, but it's a big issue in nonprofit accounting, is liquidity. Significant contingencies and commitments affecting future cash flows, significant events and transactions affecting cash flows that are unusual in nature that occur infrequently, non-cash charges to receivables, inventory, fixed assets, and long-term intangibles. That means what? The impairment kind of concept. Said, forget that, you know. If those of us who, you know, are a little concerned about these impairment measurements that are in GAAP, you know, forget it. You know, the FASB says that's not an issue between big and gap and little gap. We're not going to have this situation where a small company measures an impairment different than a big company measures an impairment. You know, we're not going to go there. Entities that are included in consolidated financial statements. Capital, regulatory, or contractual restrictions that affect future cash flows and liquidity. Transactions with related parties. Okay? In fact, if anything, in smaller companies, there's a greater risk of transactions with related parties not being disclosed than there is in big companies. Restatements, prior period errors and adjustments, subsequent events, changes in accounting principles, policies, and estimates, applying alternative accounting guidance. Now, this is going to be important because if you come to the situation where you're going to adopt the little gap rule, because as you're going to see here in a little bit, the little gap rule is elective. It's not mandatory. Okay? Even though they create a little gap rule, it's elective, not mandatory. So that means if you've elected it, you've got to tell people. You can't fail to disclose, hey, we've taken the alternative little gap rule. We're not using the big boy rule. So you got to tell them that. And I can absolutely guarantee there's going to be a lot of people who will start applying little gap rules and forget to tell people in the footnotes as our accounting policy, you know, in big bright lights. By the way, this particular accounting policy isn't big gap. It's a special case for little guys. Okay? And that's going to have to be in the footnote. Got to tell people you made a choice to use a little gap rule. Other events and circumstances that affect cash flows. You know, those things are not on the table. They're non-negotiable as far as the FASB is concerned. So you're never going to see little gap on these topics. In 13, they picked up 3 topics. These are 3 things that the FASB went through all of GAAP and said, these 3 things we're going to throw down to you, and you guys decide whether you think little gap needs to be different from big gap related to these 3 topics. And I am just underwhelmed at what they threw on the table. I mean, relief from recognizing intangible assets acquired in a business combination. Well, how many times does a little company do M&A? You know, how many are they really out there doing M&A every 4 or 5, 6 months? You know, no, not really. Allowing amortization of goodwill and a simplified goodwill impairment model. Whoop-de-doo, you know. Allowing for 2 simpler approaches to accounting for certain types of interest rate swaps when a private company intends to economically convert the interest rate on its debt. Huh? You know? If I went into the owner of one of my small businesses and said, are you planning to do an interest rate swap on your interest rates on your debt? He looked at me like, you know, put that in English, please, you know? No way, you know? These are just like massive topics affecting small private companies, right? Yeah. Unfortunately, they've processed 2 of these already, and they're almost to be approved. Numbers 2 and number 3 have gone through the process, and they're just waiting for the FASB to do the, you know, bless it and say, yeah, we're going to put this in as a little gap rule exception. Okay. I'll cover them briefly. Well, let me see. I skipped one slide ahead too much. The amortizing of goodwill and the simplified model. Let me tell you what they've decided to do, between the difference between big gap and little gap, what they've decided to do. Little gap is you can amortize goodwill. See? Big gap says no. Okay? What is this catering to? Tax, right? Tax law that allows amortization of goodwill. Okay? Now, the problem is somebody didn't bother to stick the code in front of them. Okay? Because what's the life for goodwill on tax law now? 15. What life did they pick? 10. Duh. You know, you want to make simple, you know, why don't you pick the years that the tax law has, you know? Simplified goodwill impairment model, okay? Well, the impairment model currently in Big Gap is what? Every year, intangibles, including goodwill, have to be what? Evaluated for impairment annually, okay? Now, for Little Gap, it's you have to use the same model, but you only do it whenever there's evidence of an impairment. You don't have to do it annually. So they just took the clock off, okay? That's all they did. They didn't change the model. They just took the clock off the model, okay? So we're not fighting the buzzer every year, okay? All right? And as far as the interest rate swaps, I don't even want to, I can't even spell that stuff, so I'm not even going to talk about what they did there. All right. One of the things they're working on is a master glossary of business terms, various business terms. They're still polishing up. It's sort of going to be the dictionary, okay? It's going to be an accounting dictionary, essentially. And that what they're trying to do is to have a glossary of terms and have a definition for every term that you can think of so that everybody, when they say that word, will know it means that, and hopefully everybody's on the same page with that term, okay? In terms of accounting lingo, the way we write reports, et cetera. Everybody's going to use the right word because we now have a dictionary, okay? Everybody, all entities are subject to this glossary. One definition of a public business, and the organizations that would be excluded from that. Here is the magic definition of a public entity. And I chose to go this way so that you could say, okay, if I'm not one of those, then I'm a non-public entity. I'm a private company. So here's the definition of public entity. They file with the SEC. Any kind of reports with the SEC, they're public. If they file with other regulators about their securities, okay, just because we file with HUD doesn't make us a public entity, okay? This is filing about your securities. Sale or issuing securities. If you plan to sell or issue securities, then you're public. exchange-traded securities, legal or regulatory requirement to make financial statements publicly available. That's that's a little bit of a problem right now because, I mean, what if they, we got this OMB thing that Bob mentioned a few minutes ago saying that, if you file your data collection form and your reporting package with the data with the Federal Clearinghouse, you got to make it available to the public. Does that throw you into this definition here, that now you're a public company? Therefore, you wouldn't be able to use a little gap. So, they just, there's so many moving pieces on the table, they forget to check and see, well, let's define this and say any legal or regulatory requirement to make financial statements public. Well, that, they didn't check with the guys at OMB, okay, that's about to make a rule that you got to make your financial or the Federal Clearinghouse package public, okay? So it's a problem. It specifically excludes nonprofit organizations and employee benefit plans. They are not considered public entities. And even though I know some benefit plans file 11Ks, they have their own special set of rules for doing that, okay? All right. Now, here's the one you've all been waiting for. I think I have the slide right. Yeah. Here's the one you've all been waiting for. FIN 46. Okay? I see the, FIN 46. Okay? They finally threw it on the table and said, we're getting so much feedback and hate mail about FIN 46, let's see what we can do about it. So, applying variable interest entities guidance to common control leasing arrangements. What is this? Operating company, C Corp, S Corp, whatever. Over here is what? The land and the building, LLP, LLC, something like that, usually an LLP. What? Renting to the corporation, okay? That's what they're talking about, okay? And right now, Big Gap says what? If you have those two if they have that arrangement, and there's a debt on the property, on the real estate, put them together. Okay. So where are we? What are they proposing to do? All private companies this would be available to all private companies. It would exclude public companies, not-for-profits, and employee benefit plans. Okay. Continue to apply other provisions of the leases topic and the guarantees topic. The objective is to provide gap requirements for private companies that is an alternative to FIN 46. Okay? Now, here's where you get your highlighter out. Okay? Private companies can elect to apply this new variable interest guidance on assessing whether to consolidate the lesser, okay, provided. Okay? In other words, GAP says you have to make the assessment. Okay? Management has to assess, do we need to consolidate this entity over here that's leasing to the operating company. Okay? That's what GAP says to do. They have to make that assessment to determine should it be consolidated or not. This is saying you can forego that part of GAP. You don't need to make the assessment as to whether to consolidate or not if, okay, three things. There's common control. In other words, you have the same players in both entities. Okay? You have the control. And control is 50% plus one share. Okay? So if 50% of the operating company is owned by someone who's a 50% shareholder over here on the leasing company, you got common control. Second, the lease is with a legal entity. There was a lot of confusion that came up because people kind of did a knee-jerk reaction to this thing, and a lot of people thought that if the building was owned by the owner of the company, that it had to be consolidated back in. And the issue was, well, wait a minute. The building is owned personally. It's on Schedule E of the Form 1040 of the owner. How do we consolidate a Schedule E? Do we have to make up a set of books for this thing and then consolidate? And the answer is no. Okay? The lessor has to be a legal entity, an LC, an LP, an LLP, has to be some kind of a legal entity. To just be a person doesn't put you in the ball game if it's on Schedule E. And then here's the killer. Substantially all activities are related to the lease. In other words, the only thing The only thing that the little leasing company over here does that owns the real estate is lease to the company. They do not have other operations. Okay? So if they have other operations, then you can't go into this alternative election to avoid considering consolidation. So one of the business strategies that'll have to come out of this is if you've got a situation where Company A has this little Company A1 over here that's leasing the building to them, then you're going to have to make sure little Company A1 over here doesn't do anything else. Okay? Now they can provide, for instance, support services. For instance, you could have, say, the maintenance guy. The maintenance guy could be over there, you know, and providing maintenance services or security services. But that's all what? It's all tied in with having a lease, okay, of a piece of real estate. Okay? But it can't be doing anything else, you know. They can't be an operating entity. So this is the ground they're giving on FIN 46. I particularly don't have a problem with it in the situation where you're in a non-community property state. Okay, because obviously if the husband or the wife is the owner of this operating company and the leasing company, you know, does the spouse that's not involved in the business need to know about the other entity? Probably not. Community property states are a little bit different. Okay? For those of you who don't live there and maybe not familiar with the rules, if the wife owns a company, the husband is an owner of the company, even if they don't have anything to do with it at all. Okay? As long as the ownership funds to fund that company when they issued the stock or made a partnership contribution to the partnership, whatever, were done with joint resources. If you can trace, you know, say if the wife can trace the money that was used to set up her company from daddy's inheritance, okay, in community property states, there is still separate property, and that's property you inherit. If you can show that you got $100,000 from daddy and then use that $100,000 to buy the stock and set up the company, then you can trace that, then that's separate property. But absent the ability to show it came from an inheritance, it's pretty difficult to establish that it's not community resources for that company. And now you have a problem because you have a non-participating spouse, you know, that, you know, maybe wants to look at the financial situation of their relationships and everything. And what I'm thinking is down the road, heaven forbid, they get into a divorce. Okay? And now, first thing the lawyer wants is the financial statements of what? The company. And if those statements don't tell anything about the leasing company, you got a problem. Okay? And then the second concern I have is death. Okay? That in a state, you start into estates and there's not been consolidation. That's sometimes a problem. Anyway, that's on the drawing board. That's what they've come up with. They're asking the FASB to grant this, quote, special election to create a little thing called little gap for FIN 46. Like I say, for the most part, I'm in favor of it. I think the answer is, though, for those of you who sign opinion letters on comps, reviews, or audited financial statements, the question you have to ask yourself is, does little gap, in this case, actually mislead somebody? What if the lender on the operating company is Bank A and the lender on the building is Bank B, and A and B don't know about each other? Okay, that's another scenario where I think that you shouldn't elect out. Okay? No, it isn't. They don't tell them. No. So, and if you elect out, okay, if you elect out of consolidating, then you have to show the key terms of the lease. That's why you have to have a physical lease. And I can tell you, a lot of these FIN 46 deals, there's no lease. There's no lease on a piece of paper. Okay? You got to have a lease. The amount of debt and significant liabilities of the lessor under common control. That means you have to disclose all the debt that the lessor has, where the loans are, how much they are, their interest payments, collateral. I mean, all 9 yards of disclosures about debt. Any other debt agreements between the lessor and the entity, any explicit interest related to the lessor under common control. So you get a fairly long footnote for taking, that's your price for opting out as an elective treatment. All right, so that's the one that they're working on that everybody's been hopeful about, is the FIN 46 relief. Probably won't see it till sometime early next year, but they've worked through it, and that's the proposal they have. All right, let's talk then about what the FASB has done with respect to Big Gap. So this part of the presentation is about Big Gap, and we'll get you up to speed on what's happening there. We're going to go through each of the accounting standard updates that were issued in 2013. All of us by now should be very comfortable with the process of how the Accounting Standards Code, ASC, is modified for changes in GAAP. They publish something called an ASU. They're numbered by year and then by the first, second, third, fourth, and fifth, and sixth one. Okay? So the first one issued in 2013, the Accounting Standards Update number 1, has to do with classifying the scope of disclosures about offsetting assets and liabilities. Okay? Now, the first thing you need to be aware of is when you see these updates, you need to check the effective date, because sometimes the effective date for Big Gap and public companies is different than Big Gap for little companies. Now, in this case, it happens to be the same. The effective date is the same for both of them, which was for fiscal years beginning on and after January 1. So this particular topic and an amendment to the topic 210 will become, if it affects you in any of your client situations, it will be in the 2013 financial statement for December. So, and it's retrospective. In other words, if you've been doing it, quote, and I hate to say it this way, but if you're doing it, quote, wrong, then you have to fix the statements as though you had done it right all these years, okay? That's what retrospectives means. That's that adoption word. Retrospective means change everything in the financial statements as though you had been using this rule since day one. That's what retrospective means. It doesn't mean prospective. Okay? This means go back and fix everything using this new rule as though you had always used the new rule. Now, as you might suspect, with a GAAP rule about disclosure, that just means the footnotes. Okay, it means you got to rewrite the footnote. Okay, and who's affected? Any entity that holds derivatives, and it was to clarify the scope of objectives, and in particular in topic 10. Here's the things that are considered derivatives, and if you have any of those, see me afterwards. We need to examine your brain why you're in any of these things as a small company. Okay, but so basically what I'm telling you is 2013-1 really doesn't have very much applicability here in this room today. But you need to be aware they did put out a change concerning disclosures of derivatives. Okay, so number 2, it was issued this year. Reporting amounts classified out of accumulated other comprehensive income. Okay. Again, notice the effective date. Public entities was for years beginning after 12/15 or 12/15/12, which is for this year, calendar 13. So if you were to pick up a public company's financial statements after they publish for 2013, and they have a bunch of OCI, you're going to see some new stuff about OCI and accumulated OCI that wasn't there last year. So public companies, it's 13. Private companies, it's 14. And again, you just fix it going forward. You don't worry about the past. This is called let the sleeping dog lie. Who? Any entity that reports item of comprehensive income. And the objective is to improve the reporting of reclassifications out of accumulated comprehensive income. That's like, let's make apple pie better, yippee. Okay, what are the requirements? This is a disclosure standard only. This does not affect debits and credits. I'll try to, as I mention each one of these, I'll try to help you make sure you are on the same wavelength. This one affects debits and credits, which is the books, and then this was just simply in the footnotes, or the way we write and prepare the face of the statements, okay? So this is a footnote disclosure. Okay? It doesn't have anything to do with debits and credits, keeping the books. Information about amounts classified out of AOCI by component. The components are DB, Defined Benefit Plan, that minimum liability adjustment, available for sale securities, and foreign currency. Net of tax by component, presented on the face or in the footnote and cross-reference to other disclosures. Okay? Well, best thing to do here is just to give you some examples of the footnote, the changes. And what they're basically doing is they're taking this off of the off the financial statements. And some of you have seen a company that had a bunch of this stuff. They had a spreadsheet type schedule in the statements in the walk forward of equity. And it was like 14 columns. I call them roller skate schedules. You have to roller skate that way and then roller skate back. They're moving all that crap into the footnotes. Now you move the little Excel table out of your statements into the footnotes. And you show, here's all the different categories of other comprehensive income, cash flow hedges, available for sale securities, defined benefit plan, minimum adjustment, foreign currency items, and then what was OCI before reclassification. In other words, this is the income that came in. This is the income that occurred in the OCI item. We earned $3,000 on our cash flow hedge. We moved $750 out of it to the regular income statement. And this is our net adjustment, and we're down to this is our ending balance. So you just walk the activity forward in the footnote, bury it there. The income statement. Now, instead of having two income statements, some of you may have seen this in public company financial statements. They had a regular income statement, then they had an income statement on OCI. Now you just bury it in the description. Revenues include $4,000, accumulated other comprehensive income reclassed out of net gains on cash flow. Expenses include $1,000 of accumulated comprehensive income reclassed out of cash flow. Well, look, here's what they classified out. Here's that $3,000. See, there's the three. Now they're telling you the $3,000, $4,000 gain, $1,000 loss. We grossed it up in the revenue and in the revenues and expenses. That's all they're doing. So, again, I don't know whether this is any more confusing than actually having a separate income statement that walks you through the OCI activity versus operating activity. Most people don't bother to read the captions on the left, and now you got, you don't have War and Peace out here in the caption, but it's close. By the time you explain everything that's included or not included in revenues or expenses, notice even income tax expense gets into the act. Okay, the tax effect of the OCI is now going to be down in the. You got to explain how much of that moved in there or moved out of there. Okay, notice the statements. Again, detail. Here's your detail on the gains and losses on cash flow hedges. You have interest rate contracts, other credit derivatives, foreign exchange contracts, commodity contracts. Here's the pluses and minuses, total before tax, tax, net of tax, okay? Ad infinitum, ad detail, ad nauseum. So I'm going to slip past, there's the same thing for defined benefit plan, the minimum adjustment there, actuarial adjustment, so on, transition obligation. Same thing of walking it forward piece by piece. Anyway, probably not going to affect most of you here. Number 3 that was issued. This is the topic about applicability of a particular disclosure to non-public entities. It was effective immediately upon release, which was back earlier this year. I think it was Q1 that it came out about disclosure. What disclosure are they talking about? Fair value disclosure. Okay? The scope, non-public entities that have assets over $100 million or that have derivatives. Well, probably none of you. Anybody here have assets over $100 million on your balance sheet? No, okay. Didn't think so. It clarifies the scope and applicability, okay? I don't know what they're drinking up there, but this, to actually spend time talking about this is amazing. Okay, all non-public entities that meet the criteria, what criteria? 100 million or more or have a derivative, okay, would not be required to provide the level of fair value category or hierarchy for fair value measurements in their hierarchy, levels 1, 2, or 3, for measurements that are only disclosed as opposed to being in fair value in the balance sheet. So the only exception they're making is that you still have to show level 1, 2, and 3 for any asset or liability that's on the balance sheet at fair value, But if you have something that's not on the balance sheet at fair value that you've been struggling with how to put it in the fair value hierarchy of 1, 2, or 3, you don't. But again, you have to have $100 million in assets or a derivative. So, I mean, very narrow scope. Number 4, obligations resulting from joint and several liability arrangements for which the total amount of the obligation is fixed at the reporting date. Here, this one, please note the effective date. One's for 14 and one is for 15. It'll be retrospective. We have to correct all prior periods. Again, I'm just making you aware of this. I'm not going to go into any detail. It covers joint and several liability arrangements such as debt arrangements, other contractual obligations, settled litigation, and judicial settlements, and so on. There are a few things that are not covered. Asset retirement obligations and environmental obligations, contingencies, guarantees, compensatory retirement benefits, and income tax obligations. It's not covered under a joint and several idea here. So a lot of exceptions. The big reason is there's so much variance in practice. And the variance was that some people under these joint and several liability arrangements, they were only disclosing them if the entire transaction was joint and several. If it was partial, or a proportion of it was, then they were not discussing it. So you had people who were all in, or people who said, well, yeah, we've got a joint several deal, but it only covers 20% of our debt, so we're not going to tell anybody about it. So that was the problem in practice. People were doing different things for the same animal. Now the rule says, disclose the amount you agreed to pay on the arrangement with co-obligors, plus any amount expected to be paid on behalf of co-obligors equals the total amount of the obligation of the fixed date. So if you've signed up to be a joint and several liability with other folks, then it doesn't matter whether you're on there for 20% or 100%, tell us about it. Put it out there, add the numbers together that you're obligated for, and tell us about it. Obviously, disclosure, how did you get into that boat? Why did you get into that boat? Why would you sign up for joint and several liability? What was the relationship with these other co-obligators? Like, is it your brother-in-law? Terms and conditions of the arrangement, the amount outstanding, the carrying amount. Where are you going to get the money? Where are the resources going to come from to pay that? And then this is the biggest killer, okay? What this says is you're going to record that. That liability is going to be sitting out there on the balance sheet. Where'd the debit go? You got a credit. Where'd the debit go? You got to tell me where the debit went. That's going to be fun. All right. Number 5. I don't know where they dream this stuff up, Parents accounting for cumulative translation adjustment upon derecognition of certain subsidiaries or groups of assets within a foreign entity or of an investment in a foreign entity. Okay? All I'm going to do with this one is just tell you the title. Okay? Just remember that foreign currency column. This is what that's dealing with. Okay? I'm not going to talk about it. But there is this hairy one about if you come into a foreign subsidiary and there's something about foreign translation, currency adjustments going on, the CTA, then just know that there was a change this year. Go read that topic because that new change is in the topic. Bob covered this one on the classification of the sale of financial assets and a statement of cash flows for a nonprofit. If you accept and receive securities, and then depending on when you sell them and for what purpose you sell them, et cetera, you could end up actually having cash flows from a bundle of securities. You could actually have some of it being shown as when you sell them. You could have some in operating, some in investing, some in financing, depending on what the nature of that gift was and those underlying securities. You could actually end up in all 3 categories on the cash flow statement. The services received from personnel of an affiliate. Again, Bob covered this. I just want to give you the definition where you have affiliate, you have intermediate control, direct control, common control, lots of different ways to have an affiliate. Measure the services at cost of the services provided. In other words, you go to the affiliate and you say, okay, you have 3 people in the accounting department, you have 2 people in the data processing department that work on our stuff, okay? What do you pay them? You go to the payroll ledger and add up their paychecks and what? And their fringes, and that's the amount that you record on the nonprofit's financial statements, okay, at cost from the payroll register of the affiliate where these people spent their time, what? Working on the other nonprofit organization, which means they're going to have to keep timesheets, okay? Because if they spend 2 days a week on the main company, the main nonprofit, but 3 days a week over there, or vice versa, whatever, they're going to have timesheets so you can what? Allocate the paycheck. Okay? So it's just record keeping. Okay? It's all record keeping. All right, liquidation basis of accounting. Basically, this is an area that we didn't have very much GAAP guidance on, and I think it was probably well needed, and so I want to cover a few of the points about liquidation accounting that they adopted. Note that both of them start in 14. For both public and non-public, this new provision will apply in 14. And again, it will go forward. You adopt it, when you adopt it and you account that way forward, whatever happened in the past, you just forget as though it never happened. Who? All entities that issue GAAP statements except for investment companies regulated under the ICA of 1940. And to approve the application of the liquidation basis of accounting is the goal to do that. First thing they do is to say, when should an entity adopt liquidation basis of accounting? Now, heaven forbid that that any of you have entities that you're affiliated with or associated or responsible for that are in this position, okay? But, one of the things that I'm noticing, when you hang around this business as long as me and Les has got a couple more years than I do, but when you hang around this business long enough, I just picked up a new multifamily housing project in a nonprofit organization, and also I have another multifamily nonprofit organization. Both of them this year paid off their HUD mortgage. Would I ever, when 20 years ago, when I'm looking at that, amortization schedule, do you ever think that you would get to that last entry on the amortization schedule? And I've had two of them. In fact, I'm about to issue the financial statements next week on one of them, and they got to the end of the HUD loan. Okay, the regulatory agreement's gone, the HAP is gone. I mean, the IRP, interest reduction payments are gone. I mean, did you ever think, I guess you hang around long enough, you're going to get to the end, okay? Well, one of the other things you're going to get to, some of us, I guess, is that, and I would suggest you be very careful about this. If you have a limited partnership, when is the last time you read the formation document of the limited partnership as to how many years it's supposed to be in existence? And I suspect we're going to start finding situations where an LP agreement says this is for 10 years, and we're in the 9th year. We just lost track of time. And I worry about, are people going to continue to publish financial statements in year 11 and 12 when the formation document said, hey, this thing's supposed to die in year 10? Okay? So, a couple of scenarios to think about. Well, I saw half of you turn off your mind and say, I don't need to know anything about liquidation accounting. Well, let me tell you, you might run into a couple of situations where you haven't. Okay, so let's talk about it. Okay, liquidation basis statements required when liquidation is imminent, and here is the definition of imminent. It's a remote likelihood that the entity will ever return from liquidation. In other words, they've gone into bankruptcy. And will they ever come out? Probably not. Okay? It's remote they'll ever come out. Or they have already approved a plan of liquidation by those charged with governance, or the plan of liquidation was forced upon them, okay, involuntarily by others, including third parties. In other words, the debtor forced them into bankruptcy and, foreclosure. You have third parties that can do that. So you can have voluntary liquidation, you can have involuntary liquidation. Okay? So if any of those conditions exist, then liquidation is imminent. And when you get to that point, we switched from GAAP, full accrual accounting, to liquidation accounting. We switch. Okay? And what do we have? Assets, expected cash proceeds. Assets expected to be sold in settling liabilities. Liabilities using U.S. GAAP and revenues expected to be earned and cost to be incurred during the period of liquidation. Note, when we get to liquidation accounting, we don't have a balance sheet, a P&L, and a cash flow anymore. We have a statement of net assets in liquidation, and we have a statement of changes in net assets in liquidation. Okay? If I could make a comparison briefly, for some of you who maybe have looked at the statements of a pension plan, they only have two statements. They have a statement of net assets available for benefits, and they have a statement of changes in net assets available for benefits. Well, that's the idea here. You have a statement of net assets, and you have a statement of changes in those net assets in liquidation. So you don't have a balance sheet, a P&L, cash flow anymore. So if you're publishing, the same old financial statements, copying out of the word processor from last year, and all of a sudden you found out that this is the last year of this limited partnership, you got wrong financial statements. There ain't supposed to be a balance sheet and a P&L and a cash flow. It's supposed to be these two things. Okay? Footnotes, the plan for liquidation, the method and assumptions to measure the assets, types and amounts of cost and income accrued, and the duration of the liquidation. How long is it going to take us to wrap up the show and turn out the lights? Okay? So we finally have some definitive guidance. Thank goodness. Thank goodness. So that, again, I hope you don't have to do any of that, but it's out there now. Inclusion of Fed funds effective swap rate or overnight index swap rate as a benchmark interest rate for a hedge accounting principle. Well, again, I don't know who dreams this stuff up. Does somebody sit on Wall Street and, dream up this stuff? Anyway, not going to talk about that either. The presentation of an unrecognized tax benefit when net operating loss carry forward, similar tax loss, or a tax credit carry forward exists. Okay. Public entity in 14, non-public in 15, prospectively. So just change your accounting going forward, don't change anything in the past. What it has to do with is any entity who has an unrecognized tax benefit from a net operating loss or a tax credit carry forward. Okay, so it's a very narrow scope here. Is an entity that has not yet recognized, meaning they have not yet made a debit and a credit on the books to say that the NOL carry forward that they have is going to be used. We believe that the NOL they've got on the tax return is actually going to be going through the tax return and offsetting income in the next few years. Okay? We believe that. But we've got, and they may have such a big NOL that they can say, well, we can see maybe 50 or 60% of this NOL being used, but I'm having a hard time justifying they're going to get the rest of it for the foreseeable future. So we're not going to recognize that portion as a tax benefit. So the unrecognized, that's what we're talking about, the unrecognized portion of a tax benefit and whether or not we book it or not. And there's been diversity in practice, as you might suspect, when there's not a lot of clarity, when there's a lot of bright lines, then people find ways to become creative. Okay? The unrecognized tax benefit is a reduction of the deferred asset. Okay? And notice the last one, no additional disclosures are required. I just about fell out of my chair when I read that. This has got to be the first time in history that they came up with a FASB rule and there's no new footnote required. Okay? I just said, wow. I actually penciled there. Wow. I don't have to write any footnote. I just change the presentation on the face and I move on. Isn't that fun? Isn't that fun? Here's another one of the weird ones. Okay, let me get here. Okay, that was 11. As far as I know, based on the last research I did, this is the last one issued in 13. Now I haven't checked the website since last week. They may have issued one more, but number 11 is the last one so far in 13. So the ones we just covered now, 1 through 11, are, quote, they've been adopted, they're in GAAP, and you just have to wait for the time clock to run as to when you adopt them. Now we're going to talk about what's on the drawing board. What things have they got sitting there about to become online. Okay. First one, effective control for transfers of forward agreements to repurchase assets and accounting for repurchase financings. Again, whoop-de-doo, doesn't probably affect anybody here. Okay. I gave you some slides on it. You know, if you run into it, you think you might have a problem, you might have an entity that's in this position, then at least you're looking at what the guidance says right now, and there probably won't be any change in what what's in the exposure draft for what they're talking about here and dealing with these forward forward purchase agreements and forward purchase sale agreements. They're out. What's in is secured borrowing and bifurcated derivative accounting. You know, anybody still play definitions when you have a party? You know, throw that word at somebody. Bifurcated. See if they can tell them what that is. You know, they'll look at you like, you know, where planet did you come from? All right. A second proposal they have sitting on the drawing boards or in the pipeline, about to come out, has to do with reporting of discontinued operations. They have not yet determined when it would be effective. Given that we are in December of 2013, I don't see it being effective anytime in 14 for non-public particularly. Public, maybe. If they get this out in Q1 of 14, maybe public companies by the end of 14 in their their annual statements for 14, they might have to face this, but I'm thinking the non-public it's going to be at least 15, so we got some time on this. The scope is a component of an entity that is either disposed of or meets all the criteria to be classified as held for sale, and a business that meets the criteria, acquisition that meets the criteria to be held for sale. This is purely a convergence with international standards. Okay? Purely a convergence issue. There's no problem out there in the world. Okay? This is simply to put U.S. GAAP and international GAAP on the same page. That's all it is. Okay? So, who can do it? And what they're actually doing, the bottom line here, at the end of the day, is that they've cut down how many scenarios become a discontinued operation. There used to be a fairly lengthy list of what could be considered a discontinued operation, okay? And they've actually culled about 80% of that list out. They've only got two things that really considered to be a discontinued operation. One, a component that is a separate major line of business. So in other words, you got a division over here, or you got a subsidiary somewhere, and it's a total different line of business than everything else in the company. Okay? That's one candidate for being a discontinued. If you decide you're going to sell that off, then that's a candidate for a discontinued operation. Or a major geographic area of operations. For example, let's suppose you've got operations throughout the United States, the contiguous 48, and let's say you've got sort of, say, a north region up in the New England area, and then you've got a south region down in Florida, Georgia, and those states, and then you've got sort of Texas, you know, and because that's kind of big, and then, you know, maybe you've got a western region, and then maybe you've got a northwest region. See, for operating purposes, for management purposes, you've got 5 regions, and you've got, you know, everything's accounted for that way. The reporting is flowing in from the regions that way to central office, whatever, and you operate that way. So if you decide to close your West Coast operations, for instance, then that would be considered a discontinued, if you're going to get out of that West Coast area geographically. Okay? So it's either a separate line of business or it's a major geographic area of operations. That's the only two things that now fit under the umbrella. The third one is a business that on acquisition is being held for sale. And that means that you went out and bought another company, but they had some operation that, you know, you want like 80% of what they do, but there's this little thing they do on the side over here, and you don't want it. And you tell them right at the outset, yeah, I'll go ahead and buy it because we know you can't sell that thing. We'll just take it on and we'll find somebody to buy it. We'll spin it off for you, whatever. But you know at the outset that that little piece over there is going away. It's in the acquisition documents, it's going away. Okay? So that would be a discontinued operation as well. Okay? So those are the only candidates now. They've narrowed the playing field. All entities, it's applicable to all entities. Things like you have to show major income and expense from those discontinued operations, the cash flows from those discontinued operations, the profit and loss, a reconciliation between those assets and liabilities classified as held for sale versus the ones that have been sold already, reconciliation of expense items, so on. Public company, you can see the things they have to capture: pre-tax profit attributable to component unit, which is the piece being sold off, and the parent, major classes of assets and liabilities for sale. Non-public is just the pre-tax profit attributable to the component unit of the parent, so a little less to do. Footnote disclosure, here's an example of how you would summarize the assets that are being discontinued, the cash, the receivables, the inventories, property, plant, and equipment, total assets of the discontinued operations, other assets being held for sale, total assets classified as being held for sale. And you would do the same kind of a little table in the footnote for your liabilities to identify and segregate what liabilities belong to this component or this business unit that's being discontinued or being held for sale. Discontinued means you've actually got a buyer. You know, you got somebody ready to take it. Holding for sale means you got the for sale sign sitting out on the front door of the plant. You know, that's the difference. Revenues and expenses in the income statement. You have the revenues, expenses, SG&A, everything other, pre-tax profit of the discontinued, the gain or loss on disposal of discontinued assets, the pre-tax gain or loss, income tax benefit, whatever, and finally a net profit on the discontinued, held for sale activities and operations. So it's just to break it out. It would be in the footnotes. It's not on the face of the statements. Here's one that I'm thinking, at least initially, that this might affect some of you here in the room. Accounting for investments in qualified affordable housing projects. So I want to get to my notes on this. So I had made a couple of things to remind myself of when I got here. Bear with me a second while I scoot over here. Yeah, and I may read a line or two of this so I'd say it right. Okay, accounting for investments in qualified affordable housing projects. It was the draft, or the exposure draft, was issued in April. The comments were due at June. The effective date obviously will be decided after they work through the process of the hearings and drafting and letters of comment and all that good stuff. We'll get there. They have already determined that it will be applied prospectively, meaning whatever you did in the past, just leave those numbers alone. Don't go back restating any of them. Just start forward and march forward using the new rule. Okay, what do we got? We have all reporting entities that invest in qualified affordable housing projects through a limited liability entity that is a flow-through entity for tax purposes. Okay? Now, I suspect if I ask for a survey here, I'm probably going to get a few raises of hands that some of you might be in this boat, given this definition here of limited liability entities that are flow-through for tax purposes. Provide guidance on accounting for these investments in affordable housing projects that qualify for low-income housing tax credit. I think you had a presentation tomorrow. I really wanted to come yesterday, but I had a board meeting in Dallas, so I couldn't get here. By the time I finished the board meeting and flew here, you guys were at dinner, so I really wanted to come to listen to the presentations yesterday. But I think you had a presentation, according to the agenda, on tax credits. So that's what we're talking about, is the tax credit and these entities that handle that. Okay? All right. Now, let me share with you why the reasoning is why they're coming up with a proposed change. Some of the stakeholders in these situations have said that the conditions requiring the availability of tax credits to be guaranteed by a creditworthy entity, that was one of the requirements. That's current GAAP. You have to have a creditworthy entity guaranteeing the tax credit, and the projected yields based solely on cash flows from guaranteed tax credits to be positive in order to use the effective yield method are very restrictive and should be reconsidered. to these stakeholders, these conditions prevent many investments from qualifying for the use of the effective yield method, which they believe provides users with a better understanding of the return on the investment. So what you have here is essentially, I think, the group of people who feel like their ox is being gored is those who are stakeholders, investors in this kind of situation, and they're saying, well, you know, Fred down the street, he gets this effective yield method in accounting, and I don't. Why? And he said, I'm not seeing a difference here. Why? We have two ways to do this thing in measuring and reporting these investments in these qualified housing tax credits. Okay, so that's what they're dealing with, is trying to say, you know, let's do that. And so they said, okay, probable the tax credits will be available. The investor has no operational rights. All the projected benefits are from tax credits. The yield is based solely on the cash flows from the tax credits, and other tax benefits is positive. In other words, you get a positive. There's a way to run through the numbers, and you come up with a positive number from having the cash flow from the tax credit and any other tax bennies that are out there. And notice, what's the one big thing that's gone? A guaranteed, right? See, the guaranteed tax credit from, you got somebody over here guaranteeing the tax credit. That's gone. The investor is limited liability investor for both legal and tax purposes, and liability limited to the capital investment. So here's the new criteria. They seem to be a lot broader brush than the prior criteria about these tax credits, and especially inside of limited liability pass-through entities than in the past. So, you know, as far as I can tell right now, it's a positive win-win to get more people using the effective yield method. And in fact, you know, probably most people will end up using it where we won't have such diversity in practice. Disclosures, the credits you recognize during the year, the equity method if you're not going to use the effective yield method. If for some reason you fail one of the criteria and you have to use the equity method, how much is your investment income or loss? What is the status of any regulatory review that's going on about the tax credits? Any commitments or contingencies out there? Any amount of write-downs resulting from forfeiture ineligibility of the tax credits. So, you know, it's going to be a lengthy footnote. I mean, 1 or 2 sentences isn't going to do it here, folks, if you got tax credits, but at least when they get this on the books, then many of you will be a little happier campers about the fact that you can use the effective yield method to do the accounting and reporting of the numbers. The latest exposure, the draft of things they're working on at the FASB, this is the newest one, is the disclosure of uncertainties about an entity's going concern. They issued this in June. The comment period ended a couple of months ago in September. Obviously, the effective date will be determined when they get done hashing it out. And it will be prospective in nature. Just start doing it this way, forget the past. The scope, guidance on determining when the applicability of disclosure requirements as well as the nature and extent of those disclosures applies to all entities. So what we're talking about here now, we're not talking about going to liquidation accounting. Okay? I mean, if the going concern has gotten to the point where liquidation is the answer, then you're in that new standard on liquidation. You're not here. This is footnotes. Okay? This is not debits and credits. This is footnotes. Okay? And we're talking here about what changes do we need to make to the disclosure. Not only what changes to make, but when do we need to write this footnote? That's probably the bigger issue here, is when do we have to write this footnote? Okay? And that's the biggest change that they're proposing to do. So anybody who ends up in a situation where they look like they have a going concern problem, then we're going to be here. It will reduce the diversity in footnote disclosures, providing U.S. GAAP guidance about the evaluation and disclosure regarding going concern. And I will say at this point that U.S. GAAP is going to remain different from IFRS at this point. Okay? IFRS has a different idea about going concern. Okay? So this will be U.S. GAAP only. Okay, they're going to establish 2 criteria to evaluate a going concern presumption. First of all, on the balance sheet date, okay, we look at the balance sheet date. Is it more likely than not unable to meet any obligation within 12 months of the financial statement date? Okay? So what we're doing here is that drawing a line in the sand. Is there a 50-50 chance as I look down the right-hand side of the balance sheet at all the debts and obligations that are there, is there a 50-50 chance in the next 12 months that I will not be able to come up with the cash to pay those? And is it known or probable that we will be unable to meet any of these obligations within 24 months of the financial statement date? So recognize here you got a two-pronged test. The first one is it 50-50 that there's something out there within 12 months we're not going to be able to satisfy? And is it, right now, is it known or probable that 24 months from now we're not going to be able to meet our obligations? So you got 2 windows of time to look at. Now, when do you do this assessment? Before the financial statements are issued. Okay? Before the statements are issued. So what you do is you put your stake in the ground. Okay, here's the audited numbers of the liabilities at 12/31 or 6/30. Okay, now the auditors are here in September. They're getting ready to, quote, have these statements available for release. Now management has to sit down and go through this drill. Okay? What the FASB is doing is they are not changing anything that the auditor is going to do. This is now imposing a new accounting requirement on management. In the past, the person responsible for assessing going concern was the auditor. Management had no responsibility under GAAP to make a going concern assessment. The auditor did it. They are shoving that responsibility into management's lap. Okay? And how often do you have to do this? Every time you issue a financial statement. That means interim as well as annual. So if you're issuing quarterly statements or statements every 6 months, then you've got to go through the drill of looking at the likelihood of meeting your 12-month obligations as well as what's going to happen in 24 months down the pipeline. Now, here's the next kicker. Evaluation that we have a going concern is not mitigated by management's plans outside the ordinary course of business. Okay? Outside the ordinary course of business. What does that mean? Okay? Let me give you an example. Okay? You're in a situation of limited access to liquid funds. Are you getting the message that the FASB and others are really interested in liquidity? Yeah. Significant portion of material debt issued due 10 months after the reporting period. You've implemented cost-cutting programs. You've had discussions with the lender to refinance debt. And if you can't refinance, you're going to sell off some assets, maybe even one of the lines of business to raise cash. Okay. The first first 3 items there, let's look at what resources we have. Let's look at our cash flows that's going to come in from sales and collections of receivables, the inventory turn. Let's look at our cash flows over the next 12 months and then 24 months, based on projecting them out. Let's look at at the due dates, look at the timing of the debt payments and so on. We've implemented already some cost-cutting programs in the operations to cut expenses and provide a little more cash flow, whatever. Those first 3 items, they are considered to be in the ordinary course of business. Okay? Therefore, you wouldn't have a going concern situation. Okay? And you can, you would, and you can consider them in your evaluation. But the next 2, going to your lender to talk about refinancing the debt or refinancing by selling major lines of business or major groups of assets, that's not in the ordinary course of business. And they don't count. So even though you can go to your auditor and say, well, look, the bank will refinance the loan, I think we can go down and do a refinance with the loan, that doesn't get you off the going concern disclosure. Because if that's not your practice, if you've never before gone to your lenders and said, can we work a deal to refinance and restructure the debt, if you've never done that before, then that's not something that's ever happened in the ordinary course of business. Now, if you've been down to the bank every 6 months restructuring, then you might have an argument here. But the fine line is considering the effect of the going concern matters is that these things that are outside the ordinary course of business don't save you anymore from not putting the disclosures in. Okay? So that's the surprise in this one. In the past, we've been able to use these last two items in many cases to convince the auditor not to put the going concern footnote in. We've been able to convince them to leave it off the audit report. We've put the disclosure in so that the auditor will say, yeah, the financial statements present fairly because the footnote's there now. And because if we left the footnote out, the auditor was going to put it on page 1 in the report. But now, these last two items, if we don't have a strategy that is solely out of continuing to operate, then the disclosure is going to have to be there. If our only strategy available to save us is restructure the debt, sell assets, whatever, that are not in the ordinary course of business, that's not going to save us from getting out of the disclosure. What are the conditions and events that gave rise to potential inability to meet the obligations? Effects of those conditions and events, management's evaluations, mitigating conditions. And remember, mitigating conditions are what? The top part of the screen there. That's the you don't get to talk about refinancing and selling off assets. Management plan to address the inability to meet the, okay. Leases, just talk about that. This slide is not in your book. I apologize. This is something that came up after I put the slides together. I think you have a page or two somewhere toward the back where you can, and I think the last page of my section on my presentation, there's some room under the slide there to make a note or two. Leases, why? Everybody thinks, and again, this is coming back to liquidity. Everybody feels that liquidity is not being accurately portrayed by having off-balance sheet financing, which means we're not showing the operating leases on the balance sheet. And so the push is to put them on the balance sheet again, and that's the whole animal. It's about liquidity. What is the core principle? Recognize assets and liabilities arising from a lease. The lease term must be 12 months or more, and you will have an asset now called the right of use of an asset, and you have a liability equal to the present value of lease payments. So in other words, all leases go on the books if they're 12 months or more. Okay. They have two types. We're going to have a type A and a type B. Isn't that cute? Type A, assets other than real estate. The present value of the lease payments on the balance sheet and on the income statement will be the unwinding of the lease liability discount as interest separately from the amortization of the right to use the assets. In other words, for equipment, rolling stock, that kind of stuff, in the income statement there's going to be interest and there's going to be amortization. Two different lines. Amortization of the right to use, and you have the interest expense off the liability. For real estate, it'll be the present value of the lease payments, and we will combine the unwinding of the lease liability discount and the amortization of the right to use the asset as a single lease cost. So there'll be a new line in the income statement that we'll call lease cost that comes out of the asset and liability sitting over on the balance sheet for real estate. This has obviously been on the boards for a while. They've had 3 or 4 drafts of it, but they think they're pretty close now to having what is going to be their final product. One reason is they've been dinging around with it so long they're embarrassed that they haven't been able to get it out. So I think you're going to see it next year, finalized as a document. I've kind of interspersed between the FASB as well as the Private Company Council. I found this out again after I put the slides together. I got an email. There is going to be a free webcast on Monday, 1 o'clock Eastern. Go to FASB.org. There's some instructions there to how to log into this webcast. It'll be under the PCC, the Private Companies Council, part of their webpage. There'll be a link to a webcast. There'll be downloadable slides, and then you can listen to the members of the PCC, and they're going to talk about the projects they have. And I suspect many of you would be interested in their discussion about FIN 46, the leasing company leasing to the operating company and consolidating that. They'll talk about fair value. That's another one they're dinging around with. And the tax, FIN 48, income tax disclosures, that's another one they're dealing with. And they're in the preliminary stages of those. So I think you'd find, spending an hour, hour and a half on a webcast, it's free, and listening to their discussion about, again, 2 or 3 issues that have become real thorns in the side for many of us in private companies, to see what they're going to do and what the direction they're headed, just to get you up to date. So that's an opportunity for you from 1 to, I think it's from 1 to 3 on Monday afternoon for those of you on East Coast time. All right, I've pretty much got to lunch. I had a few slides about peer review. For those of you who are undergoing peer review in 14, you may want to scan through these slides. It'll give you some direction of what peer reviewers are going to look for now that the clarity standards are out there. It's been kind of hit and miss this year because in 13, because I know as a reviewer, I've had all these reviews where half of the jobs were under pre-clarity and maybe a few jobs were under clarity. So, and that was going to be a tough battle for the firms that had to be peer reviewed in 13, which included my firm, by the way. I didn't escape that. But for 14, what we're going to be looking at, of course, is virtually all the engagements under clarity. So you may want to scan through these slides and see what I've tried to summarize is what the peer reviewer's responsibilities are under clarity, what different things they're going to look at as a result of the clarity's auditing standards. Like this slide, just to point out real quickly, the results of regulatory and government oversights. There's this new auditing clarity standard about researching to see what communications came from regulatory and oversight agencies, not just asking the lawyer. We have to ask the client to give us all the communications from HUD and REAC and whoever else sent us love notes. We're going to have to look at those documents. So, your peer reviewer is going to be considering all that as part of the risk in assessing how much they're going to look at, whether or not there's a systemic problem, if there's a constant barrage of communications coming to the CPA firm from the regulators about issues concerning filings. So, like I say, I gave you some tips to look at on focusing in the peer review, give you sort of a heads up on that in terms of getting ready. A couple of areas where there's a lot of deficiencies still. Those of you who do overall review, you might use this couple of slides to say, have we done these things? Are we documenting them carefully in our work papers? And are we making sure we're testing these things in our work papers as part of our procedures? So hopefully that'll help you if you have your review in 14. And I gave you a couple of slides about some documentation, again, for your review to look at if you're preparing for peer review this year. So with that, thanks for coming, and we're out of here for lunch.